Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. Let's continue. Paul Tudor Jones.
One of the greats.
He's the reason why a lot of young tykes got into trading. You can't probably talk about great traders without talking about Paul Tudor Jones. You want to start with anything that you particularly found insightful in this chapter, or?
Well, let's see. Let's give a little background on Paul Tudor Jones. Great name, by the way. I always like that name. Is it who's the figure from the American Revolution with a name like that? It'll come to me. But yeah, Tudor Jones got his start when he was very young, like so many. He grew up in the South and got his first break as a broker, I believe, on the cotton exchange in New Orleans. And he was a good broker, I guess, good trader. He learned how to trade fast. He got a bunch of clients. I think he made $1 million in commissions in the late 70s, like right off the bat as a very young man, and then started trading client accounts. I guess proprietary trading. I think he was just trading. Was it just trading cotton at first?
I believe so. That was his mentor.
That was the exchange. Yeah,
that was what he was hired for.
He said that in 3 years, his clients were up about 3 times. Like if they put 10 grand with him, they were up to 30. And then he had his first real bad experience. Everybody has one of these, but he went long cotton. Cotton had been trading in a range. I think he said 82 to 86 cents. It touched the bottom of that range. He thought he'd be a big shot. He went in for, he already had a big long position. Then he added to the long position. He had kind of a show of it. This is floor trading. So he shouted out and got 100 contracts executed. And then he said he could tell by the Tesco. Who was Tesco? Was that a big? Was it a proprietary trader or was it a hedger? I think it was a commercial firm, meaning somebody who was actually dealing in cotton. That's right, they were actually dealing in cotton. He said as soon as his trade was filled, Refco
was the other side.
Yep. As soon as his trade was filled, he regretted it. Somebody told him he turned pale white on the floor and said, if you need to go to the bathroom, just go right now. He gauged the market wrong. It was late in the day. There was nothing he could do about it. So he stepped off the floor, came back, and tried to sell. He said he sold 150 contracts or something, and then the market started dropping and closed the limit down. If these markets will have, all markets these days, I believe, have circuit breakers. So, they might say maximum you can lose in a day, maximum a market can fall or rise in a day. In the futures markets, they have a limit on the upside too. I don't know if the stock market.
Not everyone wants stocks to go up, but.
But let's say the cotton market wasn't allowed to fall more than 10 cents, say 12% in a day. So it fell that much. The market closed, and then on the open, it was down again that much instantly. The first trades of the day were down another, say 10 cents, and he ended up losing 60 to 70% of his clients' money in 2 days. And he vowed to. He said it was a wake up. It was a wake up call. He vowed to never let that happen again. So he started trading smaller, taking a lot more precautions, and he's remained a very cautious trader. So, and that was the beginning of his development into the truly great trader he's become.
So, one of the things we talked about before was how some of the before we got on camera was how some of the stuff gets repetitive, and one of the things that we see the pattern of what's repetitive is that they go through this this come Jesus moment. They find religion, and one of the things that going through this reading about these guys, and I'm beating myself up about it, is how they it took them one time to realize that they gotta. That's no way to trade or live, and I'm kind of annoyed at myself for learning the same lesson a lot before I made the transition. So this dovetails a little bit into what Paul Tudor Jones talks about in the chapter. And one of the things I thought that was interesting versus some of the other chapters, he gets into the emotional price that you have to pay for being a trader. So he's talking about his mentor, who's Eli Tullis, and he says, Eli Tullis taught me that trading is very competitive and you have to be able to handle getting your butt kicked. No matter how you cut it, there are enormous emotional ups and downs involved. And then, one other comment was, there's nothing worse than a bad trading day. You feel so low that it is difficult to hold your head up. Trading gives you an incredibly intense feeling of what life is all about. Emotionally, you live on the extremes. And I recall reading Paul Tudor Jones' chapter, and I don't remember any of these guys' names, but I remember this chapter being very meaningful to me. And I thought this was just par for the course, that you're gonna spend time getting your butt kicked. And I think I've spent too many years getting my butt kicked. I've said I've lost half my money 4 times. And when I was not married without kids, it was pretty tolerable for me for whatever reason. I just thought it was par for the course. It goes with the territory, and maybe it was partly, guys like Paul Tudor Jones saying that's part of getting your butt kicked. I wish I remembered the other part, which is where he made the adjustment and he took the learning lesson. I have a Paul, and go on. This stuff tells. I have a Paul Tudor Jones story for you.
Oh, you do?
Yeah. So I'm graduating college, and we're at graduation, and one of my friend's fathers says to me, what do you think about doing when you graduate college? I said, I want to be a trader. I want to go to Wall Street and be a trader, and that, I think that was. Well, a lot of people that went to college, quarter college. I went to Yale. Went to work on Wall Street, and that was where the money was being made at the time. And it was pre-internet. And anyways, long story short.
Graduated in '96.
Graduated in '96.
So people were aware of the internet. It was heating up, but it was nowhere near the mania that it became.
Yeah, I mean, and for a person who's not in the mix of it. You thought of it, the way the established world thought of it was crazy. Like Netscape, I think in '96 had a market cap valuation greater than Woolworth. And people thought that was crazy. How can a company that have no revenues and no earnings?
A lot of the country didn't even use the internet then.
Yeah. I remember sending my first email out to my friend and being like, are you receiving this note or this, did you get this email? So anyway, so this was '96, and being young and ambitious, wanted to go to work on Wall Street. I told my friend's dad that. He said, "Oh well, I have a friend who's invested in my company, and he's a trader, and his name's Paul Tudor Jones." He gave me his contact info. He goes, when you go to New York,
you couldn't Google him.
He couldn't Google him, look him up. But I had his contact info, and I didn't know who Paul Tudor Jones was. Like I said, I think I read the book by then, but I didn't remember any of the names. And so I did what I did the dumb thing is I said thanks, but I didn't do anything about it. And this is one of the great guys that you would want to have the opportunity to learn from if it got to that, or at least even be able to have a dialogue with.
Yeah.
But I told this to our friend Rocket, who had a similar experience with Leon Cooperman. His friend gave him the contact info for Leon Cooperman, and he would have done. And Rocket actually went through and made the call. And Leon Cooperman said to him, "It goes, it was pretty gruff. It sounded like it was like, well, what do you want?" And Rocket says, "Well, my friend told me to call you. Like, I don't want anything." He goes, "Well, well, thanks, or well, okay, well, and that was it. That was so, so the point when we had this discussion, the point was, well, who was to know what would have ever happened with that? But there's the lesson in that is that if somebody who could make something of that, and the way to make something of that, if anybody, for a younger person that ever gets that opportunity, gets the contact with Paul Tudor Jones or someone, is to contact them, is to do this, is because nobody, I don't, the way my concept of the world wasn't very developed, and I didn't know things. Arguably I don't know things now either, but what one could have done in the Paul Tudor Jones case was, I got the contact info, would be like, John, I'll just keep the name private for now. John gave me your contact info, and I'd like the opportunity to meet with you, and if you meet with them, then what you got to do is maybe go with like your 3 best ideas. Like Paul Tudor Jones or somebody like them has to see that you're have some value to them, right? You can't just go into the office and be like, he's a busy guy. He doesn't.
It might be like the beginning of Wall Street, the movie, where
Bud Fox meets
Bud Fox. He's always sending ideas. He's calling every single day.
Right.
Gordon Gekko's office, talking to his secretary, annoying the heck out of her, but developing rapport too. He's kind of endearing the way he does it. But when he finally gets through, he stays up all night drawing charts and making these, making a presentation of ideas. And Gekko looks at this and says, "Kid, what am I going to do with this? This is not going to make any money. This is like amateur hour." So I would guess that, a 21-year-old kid going to Paul Tudor Jones, yeah, you got ideas, but they're just going to be...
They're going to be lame, but even if nothing happened with Paul Tudor, at least you get the beginning of the way the greats think.
And if there's a rapport there, then it gives you something to talk about. He can explain why your ideas are lame.
And then the meeting's work has been worthwhile.
And he'll gauge how receptive you are to learning.
Right. And that's from the sense of if you're getting hired, and he did have a trader trainee program, by the way.
He did.
Yeah, but that aside, even that interaction, you're getting a feedback from a great trader, so that conversation in and of itself is a worthwhile thing. But so is life, and a 21-year-old such as myself didn't really take advantage of it. But anyway, that's my Paul Tudor Jones story. So
yeah, you've met my friend Ari, who, another Yale connection from Yale. He went and traded for Victor Niederhofer, who is one of the great names in trading, though his record is mixed. He's had tremendous runs and managed big money, but he has this fatal weakness where he leaves himself open to tail events that blow him up. I think that's happened at least twice, maybe 3 times. I'm not sure where he is right now, if he's down, if he's up, or if he's recovering. But Ari went and worked for him for a handful of years and said that it set him up for life. He learned how to trade, and Ari's managing his own money now and got his own firm. So that mentor relationship is incredibly valuable. You can't get that in school.
Right, and that's how Paul Tudor Jones learned from a mentor, and he meant something along the lines of later in that one of the chapters he talked about how that's part of what he would like to do too. Also, he feels an obligation to train people. He's benefited from mentors, and he'd like to be a mentor or provide some sort of training. But that was a long time ago. But I'll tell you so in my transition where, I went through this, we're getting my butt kicked half time. And, Victor Niederhofer's book, Education of a Speculator, was one of the books I read too. And I remember that being an impactful book. And I think reading those books on trading was my way of learning. We didn't have the internet or the way we have it today. And you don't know the lessons you take, but I think one of the lessons I took from it was just that it's a brutal up and down world. And when I was on just managing my own money, I felt like I could handle it okay. when it really became problematic for me was when I started managing other people's money in a hedge fund, when I had outside investors. And I came back to Paul Tudor Jones, I think, chapter when I was going through this time, and I came across this and implemented his technique, which he came across with, and which was this: every day I assume every position I have is wrong. I know where my stop risk points are going to be. I do that so I can define my maximum possible drawdown. Hopefully I spend the rest of the day enjoying positions that are going in my direction. If they're going against me, then I have a game plan for getting out. Now I spend my day trying to make myself as happy and relaxed as I can be. If I have my positions going against me, I get out, I get right out. If they're going for me, I keep them. And so
if you're holding losing positions, that's going to make you unhappy.
Yeah, and that was I came out of a day trading background, so I did monitor risk on a daily basis, and that was a hard transition to know how to transition from day trading to managing a larger portfolio, and implementing this really helped me at the time, which was that you every day you know where you're going to get out of your positions. Every day every day at the close base. Now it didn't mean the next day I was necessarily going to hit my stop point. But I knew if it were the next day, if it were to hit certain points, I would be getting out. So one of the things that makes trading difficult, for losing money is difficult. But the hardest thing I feel that's difficult is when you don't know what to do, and that took a lot of that decision that in being in limbo away, because you have your portfolio, and for every security, okay, if it does this, I'm going to do this. If it does this, there's nothing to do.
Then you can sleep. You know the rules, and if you're following them, you know your rules, and you know that your rules protect you. So if you're following the rules, you don't have to worry. Like, worrying is not going to do you any good. So your rules buy you peace of mind. So I forget what Tudor Jones said his numerical rules were, but one was if he's down 10% in a month, he just goes to cash. He closes all positions, goes to cash. So every day he knows how much, if he's in a drawdown, he knows how much he's down. So if he's down 5%, he knows that he's got another 5% of room. So that was one. And then there was a daily rule too, but I forget what it was. But again, it was just limiting his downside. He defined how much he could lose.
So that was for me implementing that was really helpful. But what I alluded to in the previous video was that I still got into trouble because at one point I came into a situation where I thought what I was trading was down so much that I wasn't going to have any rule on it. I missed the bulk of the losses. I wasn't going to have any rule, and I got really. That
was the gold market in 2014.
That was the gold market in 2014, and it was down 80%, and I thought that when it's down 80%, I'm not going to really get burned from here, and I went in and I got burned. And this.
Do you regret that in retrospect? Because let's talk about GDX. GDX had been in the 50-odd range. You missed, you were out of the market as it declined from the 50s to, where did you start to get back in, say 30?
No, 23.
23, yeah. I remember that, 23. And it finally bottomed at 12, but you rode it from 23 to 16?
Yeah.
Something like that?
Yeah, that's exactly right.
It didn't stay down below there for very long, and now it's back at 23.
Right.
How long did it take to come back? A year or so? Year and a half?
No,
maybe?
well, no. 215 it got down to I think the 12s and 215, and then it was 216 where it had the nice run where it went from 12, 13 to 30, and then 217 is when it's fallen from 30 back down at 22 and a half now.
Gotcha. So if you had just held, how long would you have been underwater back to 23?
Well, so I would have been Well, I would have recovered the money in 260, but I did. On a side, not to.
Yeah, you did.
I did recover. I got. And that's one. That's a lesson.
That's right. After you learn this lesson about how to trade in a risk-controlled fashion, you started just applying these quantitative rules, and they got you in when the market finally started to recover. And gave you a good year. Right.
And now to go back to your larger point was that do I regret? I don't know, do I regret being in that situation or getting whacking out or whatnot? But I'll say, this is one of the things he talks about, and I was going to talk about. This is what one things I wanted to talk about. What Paul Tudor Jones gets into things of transcendent value that apply in trading and outside of, and other aspects of life also. And it's one learns the most from mistakes, not successes. And when you asked me, I might not be answering exactly what you were going to ask me, but what I was thinking when you said, do I regret? And I was going to say, well, do I regret that situation or whatever happening? No, it made me better. Mm-hmm. It made me better because and that's where I was going to go to the next evolution, which is that
it made you the way you are today with what you learned from then. You would not have lost that money because when you bought, they were in a downtrend.
Exactly. I wouldn't have. If I knew today then, I wouldn't have lost the money. But the other lesson in that is that since I didn't have that lesson, I was going to lose that money someday or another anyway.
That's true. You got it out of the way.
I got it out of the way, and this goes into something I want to read to you, and then I want to talk about that time and that's the beginning of when we started to work on this stuff together. Is the idea that you can't beat the markets is a frightening prospect. That is why my guiding philosophy is playing great defense. If you make a great trade, don't think it is because you have some uncanny foresight. Always maintain your sense of confidence, but keep it in check. Says the other thing, I was totally demoralized. I said, I'm not cut out for this business. I don't think I can hack it much longer. I was so depressed that I nearly quit. It was at that point I said, Mr. Stupid, why risk everything on one trade? Why not make your life pursuit of happiness rather than pain? That was when I first decided I had to learn discipline and money management. It was a cathartic experience for me in the sense that I went to the edge, questioned my very ability as a trader, and decided that I was not going to quit. I was determined to come back and fight. I decided that I was going to become very disciplined and businesslike about my trading. And anybody that's been I don't know anybody, I've been in the markets and that up and down, and there's many times where I've wanted to quit. And that moment in 214, I thought, okay, my mindset was, okay, and this is where I get into the...
You were talking about what else you could do with your life.
Well,
other career possibilities.
I was 40 years old. Uh-huh. I had a 1-year-old daughter. I thought I had a decent run in the markets. Maybe you really can't beat the markets. I got out with more. If I leave now, I get out more. I didn't get out the way I wanted to get out, but I'm leaving better than I came in, and it wasn't a bad 20-year run, about 20-year run, or something like that. Is maybe it's 18 years at the time, 18-year run, and 17-year run, and I said, okay, if you can't beat the markets, it's a frightening prospect when you feel like you can't beat the markets. And I was looking at other options. Anyways, so that goes to the next. And part of it was also, part of it was at that point, it was happened in September of 2014. It was my birthday, and the ups and downs of everything. I said, is there any way to? I felt with the not to blame my wife and kids, but I felt with the family, the trading became tougher for me to handle. The ups and downs of it, because.
Yeah, with a family, even if you're just managing your own money, it's like you're managing other people's money.
Maybe that's what it was. I felt that
responsibility.
Yeah, if you lose it all, I eat peanut butter jelly sandwiches for a few years till I make it back. With a kid and the feeding him and clothing them and you don't want the volatility in their life. I don't think you want to introduce volatility in their life, even though what kills you doesn't make you stronger. Maybe it's not.
Yeah, you don't want that risk of a zero, whatever it is.
So that was part of it. Was it was my birthday. I'm like, what am I going to spend every birthday? For 3 years in a row, for 4 years in a row, I was getting destroyed in silver on my birthday. Like the first 3 years, I was getting squeezed. That year, I was getting obliterated. So, but that forced us. This is a long-winded way of getting at that. Forced me and working with you to make the transition to what I feel is the next level now, which is that it's really 100% rules based. I do a few things that are 85% rules based. It's not I can't get it to quite 100%, but it's as rules based as I can get, and that's the direction I want to work in. And I found that I had a profound ability to handle the ups and downs of the markets. And part of it is because maybe it's working, and maybe that's part of you feel good when things are working. Maybe that's part of it. But part of it also is that the indecision or not knowing what to do part of it is eliminated, because you know what to do at every given point. So you're not playing scenarios in your head at night saying, well, what should I do? What's the right thing to do? What's the right thing to do?
Even I mean, you can make a decision when you're trading using your human judgment. You can make a decision, but if you're honest with yourself in the back of your head, you're always going to wonder if it was the right decision. And you can make a decision on when to get out. You could define your loss, but you have to have utter confidence in yourself that you're going to follow the rule that you've set for yourself when you entered that trade. And it's like, if you don't codify everything, you can't have that kind of confidence.
What also happens is, even if you have the rule of getting out, there is going to be 99 other things that tell you to do the opposite at the time.
Yeah.
So it gets below the 200 moving day average, I'm out. But the RSI is below 30. Oh, this is not the place to get at.
Exactly. And you haven't tested which signals are valid, which aren't. You've just looked at a bunch of charts, and you've got a memory of trades you've made in the past, and you can rationalize any decision.
Yeah, you can rationalize any decision. So so when I look back at what we're doing now versus this next what we do now has been enabled because of data availability and computational power for cost effectively. But so maybe that I don't know if I would have been able to do earlier in my life, but what I certainly could have done earlier in my life is started to address the risks and drawdowns, and not do something to address the ups and downs of it. I mean, that's the part where I started with. I'm a little bit annoyed at myself for have taken 17 years to finally say what Paul Tudor Jones said after 2 years or whatever it was, or what all these guys, Bruce Kovner, said after 1 week, or and I guess maybe that's why why they're who they are.
Not all these guys have had a fantastic lifetime run. A lot of this book came out in '88 or '89, was it? So just look at Richard Dennis, who we talked about last week. Had a fantastic 15-year run, then blew up a fund and never came back. He walked away from the markets. But I'm confident that what we do, these strategies that we run today, will continue to work for the rest of our lives. But even if they started to fade, they're not going to blow up. They would just stop working, maybe slowly bleed. I could conceive of that happening possibly, but then you think it through and you could see how that can't happen. But anyway, aside from the strategies themselves, which are extremely robust, I mean, I've just completed a study going back to 1930. If you've been running our types of strategies going back to 1930, they've worked continually. They didn't look any different than the 50s, 60s, 70s than today. They work great the whole time through all kinds of different markets. They're just very simple rules. Nothing fancy about them, really. And that's what you want. That's very robust. Just like all these guys, when it comes down to it, they learn their lesson and then they all start doing the same thing, more or less. But our approach of of distilling everything we do to simple rules and testing those rules with a wealth of data and trying to break them. That approach will allow us to find new strategies. I mean, what we're doing now is not the only thing you can do. There are other strategies that have, we believe that ours is the best for various reasons. But this approach of taking into account historical data and forcing yourself to distill what you're doing down to a handful of very simple rules is just the only way to go. It's very, very powerful from a returns point of view and from a psychological point of view. It's really the only way to play as far as I'm concerned.
So, talking about just the edge it gives you psychologically, I vaguely recall something, they do psychological tests on what it takes to be the right personality to be an NFL quarterback. And the personality suit type that's best for an NFL quarterback is someone who's a very religious person or a megalomaniac. And I don't know much about psychology, but the way I think about it is just that there's just so much enormous pressure that's put on the shoulders of an NFL quarterback that the only way they can withstand it is to be able to lean on something such as God, or that they just think they're so great that I guess they're delusional and they don't need to lean on something. So when you manage other people's money, I mean, everyone feels about it differently, but it's enormous. It's a great burden and it can be a great pressure. Especially if you're dealing with real people who really depend on that money.
My comment on the being an egomaniac or believing in God is that they're both very strong belief systems that will prevent you from equivocating. And because that's what gets you in trouble. If you can equivocate, you can come up with a rationale for anything. Whereas in a religious structure, one of the functions of religion is to give you parables for various life situations and make it very clear what you should do in any of these common situations. And there's nothing new. I mean, a religious person will find a parable, will find a rule that governs behavior in almost any situation they'll encounter. And an egomaniac, well, he's just going to do what...
Because he's right. Whatever he does is right.
Whatever he wants, he's going to believe in that and just do it. And so they'll make the decision fast when they need to make it.
So when you manage outside money and you have the burden, having this system to rely on is very nice and for a money manager, because it takes out, I guess, now that you've articulated it, it takes out the equivocation in the process.
Yeah.
And
you want your world to be simple.
Going back to going up to the one point about getting to where we're at is, and I'm beating myself up about it, but part of it is that maybe you have to go through those things to distill it down to understand how to make it simple. It's not easy to make it simple until you really understand it really well.
Yeah, I guess it's a Darwinian process.
I have a few other things I want to talk about before we wrap up. One is this. Before I don't want to run out of time, so I do want to talk about the things that have transcendent value, the things that you can learn from Paul Tudor Jones, which he picked up from trading, which you can apply anything in life. And one is that you learn most from your mistakes and not successes. The other one, which I thought would be interesting to discuss, is people just don't want to believe that anyone can break away from the crowd and rise above mediocrity. There's this idea that people say that humans like to pull other humans down, the way, the proverbial crabs in a bucket. So I've thought a little bit about this. I didn't really believe it per se, but I've thought a little about it. You have any comments on that?
I think people pull themselves down more than others pull them down. You start to get ahead, and maybe you don't really believe in yourself, so you start to violate your rules, and maybe that's maybe it's you get a big head, but maybe it's just getting sloppy.
Well, there's I don't know much about it, but the idea of you sabotage your own success, and I guess that comes from the idea that in your mind you have a construct of where you are, where you're supposed to be in this world, and if you're getting outside that comfort zone of your self-worth, I guess maybe you pull yourself down. I have
a friend who's managed a couple of big companies, and he said that in his observations of employees, he could see, I guess from position of authority, he thought that he could see their lives better than in another context. And he said he could see how they were all trying to fail in their own ways. Most people are trying to fail.
He thought it was intentional.
Not conscious, but
something was happening.
It's the only way to explain how most people sabotage their own success.
So that's an interesting take on the self-sabotage, which is certainly we are our own worst enemies idea. But there was the one thing I wanted to highlight in this, which I took it at face value, which is that people just don't want to believe anyone can break away from the crowd and rise above mediocrity. And I was thinking, why is that? Why do people, if that's true, why is that? And I think it's this. Because this is certainly to some degree I've seen where people want to take the easy way out. Like if you think it's possible to rise above mediocrity, well then it's a lot of work. And it's less work to say, well, it can't be done. And then you can go back to enjoying yourself.
It's risky. It's risky. We talked about this so many times, but to truly be successful in the markets, you have to be willing to break with the crowd. And that takes courage. It takes belief in yourself. You're going to get negative feedback because there are going to be times when the crowd is doing better than you. People have a short memory. And maybe over the long run you're doing way better than the crowd, but nobody sees your long run track record. You don't feel your long run track record until you've got a lot of years behind you. And even that, you might not always get away from it. You're in your own mind, to some extent, you're only as good as the last year or so, or your last month. And there's no way to get ahead without being willing to underperform for months and a couple of years. I mean, Buffett's underperformed for 6 years at a time at one stretch. So you have to be willing to do that. That's the price. Yeah,
I mean, if you want a different outcome, you have to do things differently.
Yeah, and I think we're hardwired not to do that. And it's just there's this whole incentive structure that within the industry there's an incentive to benchmark, to have performance that's approximately like that of the index, because you're penalized so harshly for lagging when the index goes up, but you're not penalized for going down when the index goes down. Even what's perverse about it is that by giving up a little bit of upside at times when the index is going up, you can protect yourself against these massive losses from time to time. And so from a purely rational point of view, you come out way ahead if you take that little sacrifice during good times and in exchange for completely bypassing a bear market. But psychologically, and often from a career, from your ability to advance within an organization or to raise funds, you're often better off just going with the crowd. Because, you know, if there's a crash and your accounts are down, that's, you know, it's like it's not your fault because everybody's down.
Yeah, there's something in the misery loves company, or people are more tolerant of when you lose with losing good company. Yeah. Right? They're just kind of the old saying, you know, nobody went broke hiring IBM.
Exactly.
This is, you know, one of the other things of transcendent value. I think one of my strengths is that I view anything that has happened up to the present point in time as history. I really don't care about the mistakes I made 3 seconds ago in the market. What I care about is what I'm going to do from the next moment on. I try to avoid any emotional attachment to the market. I avoid letting my trading opinions be influenced by comments I may have made on the record about a market.
Like an algorithm. An algorithm doesn't know how much it's up or down. It just knows the rule.
Has a short memory. No memory. And
it just checks. It checks long out. That's it. Yeah.
And that's where it dovetails, that comment dovetails on what you said on the last video, which was that, you know, sometimes it maybe makes sense to trade or not even knowing what the asset is.
Yeah, I wish I didn't know what I was trading. Honestly, maybe I should figure out a way to do that.
You'd have now. That would be funny because you'd have to do with you'd have to work with a broker who
I could do it. You handle the trading. I'll just
tell me asset.
We'll come up with a code. You give me the code. I'll run the numbers with the code with the code, and I'll give you the code. I'll give you the right codes to buy.
Right, or we give it each a name that has no correlation. You don't know the correlation of the asset. No, see, you got and you got to change it each time because then you'll be like, oh, this code. You start developing a price history for just that code.
I can attach the numbers. You know, the Chinese, they don't have numerical ticker symbols. They have numbers.
Right. But
and then that's a problem though because they have this whole superstition around numerology.
Right.
So you know the one with 888, that's your winner. And nobody wants what are their unlucky numbers? Is it 3? I forget.
I don't know the unlucky Chinese numbers, but that'd be an interesting way to that'd be a tough one to solve, but the point is
I know that my trading record over my lifetime trading record would be far better if I never knew what I was trading.
Yeah, I mean I agree.
We got to think about this. We got to think about this. That's a good idea. I don't know how to sell it though. Nobody believe you.
Well, nobody believe you. They think you're crazy. Even if you put on a suit and told people and wore eyeglasses and told people that. Is there anything you want to talk about before we close up?
No. If anybody's really into Paul Tudor Jones, find this documentary.
It's very hard.
Trader.
I think he's paid a lot of money to get rid of it. It keeps coming back on.
You can find it if you know where to find things on the internet that people don't want you to find or download for free. You can find it. It's called Trader, Paul Tudor Jones. Great scenes in there from the 80s. He's got this. He's got a quote machine with a little metal antenna, extendable antenna. He's walking through Manhattan with.
That's hilarious. Different world.
Yeah.
Now that's part of.
There's Bruce Willis's lucky shoes.
What he bought?
He bought a pair of Bruce Willis's sneakers. I don't know, at a charity event, and he puts them on for good luck.
I haven't seen the movie, but I remember that scene. I think I've seen a few minutes of it. You bring up that point, which makes me think of this, which is that some of the people, today's people, begrudge that they weren't born in a prior time or prior era, and they could have done well. But that shows you that every time has its pluses and minuses. Paul Tudor Jones had to walk around with a Quotron machine in the streets, and it was probably very expensive. Very few people could afford that. And that information is available to everybody today.
Yeah, he had to have accounts with brokers on the floor. He had multiple brokers. in each pit in all these different exchanges. I mean, the barriers to entry were huge. He said that he has this giant overhead.
Yeah, that overhead of the Bronx Zoo or something.
Yeah. Yeah. So this world is far more accessible than it used to be. I mean, you could teach yourself to trade with a $10,000 account. Using free spreadsheet software and an iPhone, while having a regular job, and you'll have more information than Paul Tudor Jones had in 1987 with $100,000 a month budget.
Incredible, great times.
Yeah. So that's it. Just good luck out there. Hope you don't have as big a drawdown as this Jones did, but learn your lessons and value those lessons. You want that pain. That'll make you better.
I mean, not to spend too much time on that, but that's part of the idea of these videos is that we learn from Paul Tudor Jones. Maybe people can learn from our mistakes, learn from some of the things we did right. Hopefully you don't spend 17 years to figure out that the ups and downs of trading can be addressed, and it's better for your long-term life. So thanks for watching.
See you next time.